Welcome back. Stock market hasn't broken out for a while. We're going to take a look at exactly how significant that breakout is. Actually, we're going to have a very long-term look at the different markets as well, the stock and bond markets. First off, we see here the white line is the S&P 500. The white histogram bars show us to the degree of which the breakout, when it does occur, how significant it is. Specifically, we see most recently the S&P 500 hit a new high December 10th, 2021. Now that registers a level 2,899, 2,900. That means 2,900 days has gone by since the market was able to accomplish a higher high. That's how significant that breakout was. Now the red histogram bars at the bottom show us in terms of breakdowns. When the market goes down, how far back do we have to look in time in order to see the S&P 500 accomplish a lower low? The most recent significant breakdown we saw was October 12th, 2022, when the S&P 500 registered lows around 3575 roughly. At that time, those histogram bars registered a level of around 494, almost 500 days, meaning 500 days before October 12th, 2022 was the last time the S&P 500 hit lows around the 3500 level. The longer period of time we have to look back into history to see the market at a higher high or a lower low very simply shows us how significant that breakout or breakdown is. This is the S&P 500 present day. So far, we're in a very tight trading range here. We see currently 41.36. The most recent swing high we saw of any significance was April 28th, just a couple weeks ago. We hit a 62-day high. Now, before that, we hit a very significant high, S&P 500 around 41.79. That represented a 116-day high. If we're able to see the S&P 500 above 42, for example, or even 4180, that would register a very new significant high. And that would really put all the traders that bought the S&P 500, that would put them in a profitable position. And anyone selling short the S&P 500, well, it would put them at a loss, meaning if they were sold short, they'd have less margin. They'd probably be closer to their stop losses. Well, let's consider also the bond market. This is a 1-month bond. 1-month bond currently registers 579 yield, very much in a trading range. The last significant high we saw was a 483 yield going back to March 9th, just about a month and a half, about almost 2 months ago. So that was a pretty significant high. If we can register highs above our very recent swing high of 581, that certainly could bode higher. But the 1-month bond has already experienced a very, very big rally. It's not a lot of traders out there that may think we're going to see even higher highs. Same holds true for the 1-year bond. Present day, we're at a 475, very much in the trading range. We'd have to see a breakout above 525 or a breakdown below 419. This is the 10-year bond, which has been on the weaker side of the maturities. 10-year bond currently pays a 346. Most recently, we saw a new swing low of 3.3%. That was on April 5th. That did register a pretty significant high, or a pretty significant low, I should say in this case, 151-day low, almost half a year. And if we see the 10-year bond making lower lows, that certainly could encourage a lot of traders to bet on even lower lows on the yield for the 10-year. Going back in time, this is the S&P 500 between 2007 2009. Now, we know the market was trading around 1,600. This was mid to late 2000, July 2007, October 2007. We started to roll over. All of a sudden, the S&P 500 hit a very significant low around 1310. That represented at the time a very significant low, around a 326-day low. We had not seen a lower low in the S&P 500 for over a year, but the real break occurred on July 15th, '08. Everybody remembers that day. That's when the S&P 500 hit a 500-day low. Again, the more time we have to go back in time to see a higher high or a lower low adds to the significance of that breakdown or breakdown. If we were to sell shorts or bet on stocks going down July 2008, well, the S&P 500 very quickly fell from 1200 down to around 676. A very, very significant low indeed. Now we can see as the S&P 500 started to recover 2009, we did register higher highs we had not seen for quite a while, going up to a 400-day high April 2010. Now, taking a look at the 10-year bond, same period of time, 2007, 2009, we saw the 10-year bond hit a pretty significant high. This was June '07, but then broke down. The real piece of confirmation was September '07. Now remember, the S&P 500 really didn't have a big break until 2008. But the 10-year bond gave us a hint what was to come. That's when the 10-year bond hit a 434 low. That low was a 188-day low. Currently, by the way, the 10-year bond is not near significant lows, but it's not that far away either. If we do see the 10-year bond register significant lows, that could be very similar to what we saw in '07. Now, we look to the 1-year bond, which is certainly a lot more volatile than the 10-year, and take a look to the 1 year. It had already registered pretty significant lows, but then again, 95-day low on April 24th, '07, before the S&P 500 broke down, about 3 months before the 1-year bond broke down. And that led to a very, very tumultuous period of time. And then, of course, the 1-month bond, we've been watching very carefully lately. Take a look to see what happened. This is May 1st, '07. Several months before the S&P 500 broke down, we saw the 1-month bond, the T-bill, hit a 145-day low. Very, very significant low indeed. And then, of course, the T-bill dropped from 5% down to pretty much zero. That's why one of the reasons why in our discussions of the bond market, we've been watching the short-term bonds, especially the 1-month T-bill. It seems to act as a trigger when the market's ready to make a move. Now, here's a very long-term view, going back to 2006 through present day, 10-year bond. And I wanted to bring this up because I really think it's important not only to note when the markets make new highs or lows, but also how long since it's made a big high or big low. So right now we have the 10-year bond. We know it's around a 337 in that area. We just recently saw a 4,000-day high on the 10-year bond. That's how significant this interest rate hike has been over the past couple of years. Seeing a 4,000-day high, 4,335 to be exact. We have not seen a significant low on the 10-year. Well, we have to go all the way back to September 19. So that's a pretty long period of time. That's a 10-year. That's forecasting long-term economic conditions. This is the 1-year bond going back, again, 2006. That very significant high we saw, well, we could say the 4.5% yield we accomplished, that was on October 14th, 2022. That was also, a 4,000 day high on the 1 year. That's how significant these higher interest rates have been. And then, of course, a 1-year bond, very significant highs as well. Now, notice also the gap, the period of time in between these big significant highs. The last time we saw the 1-month bond, the T-bill, I should say, above a 2.5% since this recent rally was going back to 2019. 3 years had transpired in between those very significant highs. Now we see here, of course, the S&P 500. Now notice the frequency of the white lines as the S&P 500 rallied higher. We saw those very, very significant highs accomplished December 21, January 2022. But since then, very, very little has gone on. The most recent significant breakdown on the S&P 500 was September 22. So we really haven't had any credible signal, any significant signal, as far as a breakdown, going back, well, that's about 8 months now. 8 months since a breakdown. Notice the gap between red lines. Before 2022, we have to go back to 2020, about 2 years. Before 2020, we have to go back 2018, about 2 years. Before 2018, 2016, about 2 years or so. So it looks like the gap in between breakdowns, between these red histogram bars, is around 2 to 3 years. Maybe that means that, well, we're only 8 months away from the last breakdown, but it doesn't necessarily have to follow this pattern. It could come before or after, but the markets are cyclical, and we're not the only ones looking for these patterns as well. So maybe there's a little bit of a self-determining prophecy in that. Point being is that, and we really want to try to ask ourselves, how can we use all this information? Well, what do we know? We know that the market is in a very tight, or not tight, but a very compact trading range, so to speak. We're nowhere near making new significant highs or new significant lows. But a good amount of time has transpired since that has taken place. Now, as far as the bond market, the yields point to the upside. We've seen recent breakouts more towards the upside. We can see here, for example, again, the 1-year bonds. We've seen white lines occur more recently than the red lines. Same thing, that's the 1 year. Here's a 1-month T-bill. The white lines have occurred more frequently. So we know the trend is your friend. And for the time being, the trend in interest rates is to the upside. The trend in terms of the stock market, well, the most recent signal of any significance we've seen was to the downside, but so far in a trading range. And I guess maybe that kind of makes sense. As interest rates continue to climb and we tend to see new significant highs in bonds, maybe that adds extra weight. In fact, we know it does add extra weight to the economy, and perhaps acts as a drag to stocks as well. So we're going to revisit these charts from time to time, and we'll be sure to update you along the way with any significant move, because that certainly could be a signal, and a signal of what's to come in the near-term future. We hope this has been helpful. We look forward to seeing you back soon.